Mihika joining us to tell us what are the latest updates. Mihika, over to you.
Thank you so much for that. So we have TCI Express, which is in focus now. It's been dragging and I was, performing very bad all of 2024, and that's something that we saw across all logistic performers. But amongst its peers, while Delivery, TVS Supply, VRL have seen steep corrections in 2024, TCI Express was the worst performer, down about 41%. Now there were multiple factors dragging TCI Express down. One is a weak Q2, where volumes were hit because of slow growth in key sectors like manufacturing, auto, and textile. The company also saw higher costs from because of its multi-modal enhancements and high inflation adversely affecting customers. The management also lowered its guidance. They expect mid-single-digit FY25 volume growth versus the double-digit guided earlier. And when you talk about what we can expect for Q3 FY25, well, as per Motilal Oswal's channel checks, they've suggested muted volume growth in the October to November 2024 period. They also expect weak volume performance in Q3 FY25 and for FY25 as a whole as well. And the company may struggle to generate volume will have a hit on the company's growth as well as margins. When it's key to note there are some positive long-term factors. The branch expansion will help enhance the company's market presence. The asset-light model will help minimize the idle capacity during periods of downturns, and the company continues to make investments in automation centers, which will help efficiencies, and it does have a target of 2,000 crores in revenues in the next few years. However, from a near to medium term perspective, headwinds still persist. When you mention what are those, heightened competition, there's weak rural as well as MSME customer demand. There's a consumption slowdown, which is a theme that we've seen in the second half of 2024, elevated inflation as well as no expectation for a price hike, and this is something that Motilal Oswal has stated that the company has indicated as well. Lastly, when you talk about your valuations, because of the steep correction, current price to earnings ratio is at 23.7 times versus the 41 in FY23, and it is trading below the 5-year historical PE of 36.89. And when you look at what analysts believe, well, it does have 6 buy calls, but the hold calls stand at 5 and the sell calls remain at 2. And maybe because of the steep correction, there is a 12-month return potential of 32.5% as per the consensus estimates.